thanks so much for being here. We wanted to record this for those of you who have followed us through Wealth Builders Investments, both as clients and as just new friends. And we're going to go through today some of the information we're talking about with the markets, with the economy, thinking about this from a biblical worldview. And I have a slide deck I'm going to share. And so let's go ahead and jump into the presentation. And I appreciate everyone being here today. One of the things we do have some handouts that I'll provide you all. And again, what I want to do is really talk about the markets. We're recording this with a group of you around the middle of October, 19th of October. And we've had a lot going on in the U.S. markets and the economy, and wanted to provide you some insights on that. So I want to start today's program by just sharing a poll, and just to kind of understand who we have in the group. So on the right-hand side of your webinar screen, we have a poll there. As we get started, if you'll just take a quick second. Some of you are current clients that our team at Wealth Builders Investments and myself, we work with you on financial planning, investment management. If you're a current client, just give us a click and let us know. If you're a new visitor, maybe you heard about us through Lance Wallnau Show or through Billy Epperhart's Wealth Builders platform or the Kingdom Finance Show. We're excited you're here as well. So please just give us a click, let us know who you are. We do these webinars once a month. And we do broadcast them out to current clients, and then also just to new friends and visitors that may have heard about us. So we'll give it just another second here on that poll. And then a lot of you are new visitors, so welcome. Welcome. Again, my name's Chad Franzen. I'm the CEO, co-founder of Wealth Builders Investments. And so a lot of you I have probably not talked to before, or maybe you've heard us on Billy Epperhart's Wealth Builders platform or our podcast, the Kingdom Finance Show. So there we go. 90% of you all are new visitors. So thanks so much for joining. That's awesome. Usually it's about a 60-40 split between current clients and new friends and visitors. So thanks so much. Whether we've been working with you for months or years, many of you are longtime clients, 10 years or more. And but thank you all around. So all right, and then we've got one other poll. One of the things, let me introduce this concept, and what I want to do with our time today, I'm going to share my slide presentation. We're going to go over some of our thoughts on the economy and the markets, how we're investing our money, both personally and professionally as a wealth management company, give you an update on the Fed. And I'm also going to make available at the end of the presentation, if you'll stick around, I will make the handouts available on the right side of your webinar screen for that. So again, don't feel like you have to take a ton of notes. I'm going to share these slides with you all. One of the things, I'm going to put up a poll question. I have just my second question here to start us off in. This helps me also get feedback as we're putting together the teaching and education material that we do. But the second question here is, what stage of investing are you in? And let me explain this before you answer it. So a first X investor is a beginning investor. You're maybe learning how to create a budget. You're learning how to get out of debt. You're learning how to start saving, right? You can be any age to be a 1X or first X investor, but you're definitely kind of starting out. You're trying to learn the ropes. You haven't done a lot of investing in the past. Maybe you're trying to work on paying down debt or starting a job or, creating a budget and that. So that would be your first X investor. So if that's you, click the first X. Again, we're all on different parts of the journey. I'm not going to share these results. This just helps me get feedback for our teaching material. Now, the second X is you have had some experience in investing. Maybe that's been through a 401k or an IRA at an employer. You've done some investing, maybe a little bit in the stock market, or you've invested in CDs at the bank, or perhaps even a little bit of real estate here and there. So you're starting to get a little bit of handle on it, and maybe you've even done some of this yourself. Maybe you've worked with a financial advisor or stockbroker in the past for that. So again, some experience in investing and financial planning, maybe, over a handful of years. That would be a 2X. We call it the second X investor. And then the third X investor is really a very seasoned investor. It's a man or woman who has had a many years experience in investing in a lot of different things. Maybe they've owned small businesses or franchises. They've invested in real estate, the stock market. You've done a lot of different investing over a longer time period for that. Now, again, first X, you're kind of starting out, trying to understand where you are, create a budget, pay down debt. Second X, you have some experience in investing in different things. And then the third X would be the most experienced, the most amount of time spent in owning businesses, investing in the markets, whether it's real estate or stock market. So again, if you don't mind, just give us a answer on that. First X, second X, third X. And what we do, my business partner, Billy Epperhart, actually coined this phrase, the triple X factor. Now, I have a whole separate teaching on this. I'm not going to cover it in detail today, but I want to at least introduce it since we have so many new visitors on today's webinar. There's really 3 different X of investing. The first X is where you're trying to get your income to match your debt. So whatever your monthly budget is for housing and car and expenses, your work income, your W-2 wage income, you're really just trying to get that above what your debt is, what your lifestyle budget is from month to month. That's the first X. And the second X is where you start to have some disposable income, some discretionary assets where you can actually invest, and the interest or dividends that money makes, once it starts to get up to how much your monthly overhead is, your monthly budget for living, when that passive income starts to meet that, then you get to the second X for that. And Billy teaches in his book called Money Mastery, once you get pretty far along into that second X, you get to the area we call financial freedom, which just means your passive income can pay for your lifestyle. And then the third X is a little bit of rare air. Not everyone gets to that, but you get to the point where you have passive income from businesses or investments, and they're creating enough cash flow where you don't even need it all yourself. You don't even need it all for your children or your grandchildren. You can actually use some of that third X income. Again, we're talking about investment income, cash flow from things like dividends or real estate or just business distributions. You can use that for kingdom impact purposes. So again, first X, second X, third X, kind of threw that in just based on the poll. Thanks for everyone's feedback. Pretty much across the board in 1X, 2X, and 3X. So thank you all for providing that. Well, let's jump in on today's webinar. I really want to focus on providing you some economic insights from our team at Wealth Builders Investments. I've put together some slides here, and let's go ahead and I'm going to share my handouts, and then I will make this presentation available to you. I'm going to present for about 20 minutes, and then also give you an offer at the end on how you can get a personal one-on-one consultation. So please stick with me for the presentation. I'm going to share with you how to get access to our team, and we'll be happy to give you a one-on-one consultation, whether you're a current client or whether you're just someone that a new friend that you ran across us on the Kingdom Finance Show or through one of our other platforms. So let's jump in, and I'm going to go ahead and share my slides here. All right, well, you should be able to see my screen now. Again, Wealth Builders Investments, we are a registered investment advisor. And again, this presentation for educational purposes, really what we do, you can find us at wealthbuilders.net. My background is as a certified financial planner, and our goal is to help people make sense of making money for making a difference. And we often say helping you to bring clarity out of chaos. I mean, how many of you would agree we are in a bit of a world of chaos right now with everything going on politically in the US with the economy and interest rates? And then we start looking at, just the very sad state of world affairs with what's going on in Israel, what's been happening in Russia and the Ukraine. And, it really causes our hearts to be heavy, and obviously want to pray for God to bring deliverance and peace to the unrest that we're seeing in Israel and the Ukraine, and even in our own political landscape in the economy here. So what we attempt to do with our team at Wealth Builders Investments is just help you become better stewards with your businesses and with your personal financial resources on that. Again, this presentation we put together for the month of October, and I think you're going to like it. Again, for educational purposes only. We'll be happy to provide you one-on-one advice, but again, this is really to provide you an update on our view of the market. So this is our economic update. We did one a couple of weeks ago. I wanted to come back and revisit this because I think there's some additional data that I want to share. If you're not already familiar, please visit the Kingdom Finance Show. We put out a new episode every week. And again, you can find that on Spotify, Apple Podcasts, YouTube. If you're seeing the screen here today, you can take a picture of that QR code and it'll take you directly to the links for the site. But you can obviously just go in and search for Kingdom Finance Show on Spotify, Apple, or YouTube. And please subscribe there because we release new content every week. We do economic updates. We do market insights. And one thing I'm really excited about is we're starting to bring on some guests from different parts of the business world, different parts of the economic world that are doing some really good things. They follow our view of conservative values and of trying to make the world a better place and investing to make an impact while still having a good market rate return. So again, that's a great resource. Want to make sure you know how to find us and follow us on that. All right, let me jump into some stats. I'm going to share over the next 5 to 10 minutes some slides that our research team has put together on the economy and what's going on with the market. Now, this first slide is the median return by asset class. So one of the common questions our team gets is, Chad, what type of rate of return can I be getting? Can I expect right now with where interest rates are and where the stock market is on that? So again, I'm just going to provide you some statistics today. These are current through the middle of October 2023. High yield savings accounts are actually the median return on those is 5.5%. And then you can also get a 6-month U.S. government treasury bill, and they're yielding around 5%. Now, again, these rates, they do bounce around from day to day, week to week, but just looking at some median returns on that. So high yield savings account, 5.5%, 6-month treasury bill, 5%. Now, for those of us that invest in real estate, particularly in the commercial real estate market, they have what's called investment property cap rates. Now, I don't have time today to teach on what a cap rate is, but in effect, a cap rate is the cash flow that you're making on a property based on its value. So, right, what the value of that property is, if it's worth $100,000 property and you're generating $5,000 a year on that property, that's a 5% cap rate. So right now, cap rates in the investment real estate, particularly on the commercial side, are somewhere around 4.5%, 5%. The median is actually closer to 4.5%. And then the final stat here, the S&P 500, the earnings yield on the S&P 500 is a little over 4% on that. Now, these are the median returns by asset class. Now, let me just share a couple of observations, which I put here on the slide. Cash, which is represented by the high yield savings, and treasury bills, which are two of the safest asset classes, are now paying a higher yield than both real estate cap rates and the S&P 500. So you might say, well, Chad, what what does that mean? What it means is that risky assets, such as real estate and the stock market, they're actually paying less than what we call, quote, risk-free assets, that being high yield savings accounts like money markets, FDIC insured CDs, and then US Treasury, short-term treasuries on that. So something's wrong when you take risk and you actually earn less than just holding it in cash, right? This is actually the first time, interestingly, since 2000 that this is true, where treasury bills are yielding higher than what the yield on the S&P 500 is. So what that tells us is that financial gravity at some point is going to have to come into reality, because this is not sustainable. It's really inverted. What you should see happening is real estate cap rates, S&P 500 yield should be higher than the, quote, risk-free rate of that. Now, I'm going to talk about here as we move forward. Okay, Chad, well, how do we take advantage of that? What are some things as a savvy investor we should be doing? Now, I shared this on a previous episode of the Kingdom Finance Show, this whole topic about cash is king. One of our opinions right now is that we think real estate prices still need to come down more, and we think the stock market, the S&P 500, is still overvalued for where it really needs to be on that. And in fact, as of this recording this week, the S&P 500 has been somewhere around 4,300. The Dow's been over 33,000, 33,400 on that. So we think things are still overvalued in the stock and real estate market. So conversely, if we look at cash, and let me just make an application here so you have some takeaways. Here are some rates. We went out and shopped. This was at the end of September. So the different commercial banks, Wells Fargo, Citibank, Chase, B of A, they are not paying anything to speak of on their deposits. Less than 0.25%, as you can see here on our chart. Wells Fargo was paying the highest, and they were paying 0.15%. So one tenth of 1% on cash that's deposited. And Bank of America and Chase were paying really nothing, 0.01. So again, I'm going to show you another chart here, because this is a huge takeaway. If you take nothing else away from today's program, it's that there's really no need for the everyday investor to be keeping their deposits with these big five banks when they're not paying us anything. Inflation is high. Interest rates are high. When interest rates are high, as you see on my chart here, you can go invest in FDIC insured CDs, money markets, or US Treasury bonds, and you can get anywhere from 4 to 5% on those. So my personal opinion and encouragement to you would be, evaluate whether it's your own personal savings, if you help run a small company, a big company, or even a ministry or a church, a nonprofit. Look at your cash management, because in today's environment, we do not need to be just having our cash sitting there earning nothing. Now, I don't think we should go put it all in real estate or the stock market right now, but there's nothing wrong with putting it in a 4 to 5% quote risk-free asset while we evaluate what's happening geopolitically, what's happening with the election, what's going to happen with interest rates and the Federal Reserve. So a lot of money is flowing out of these big banks. And let me just show you this slide. This was from one of the investment managers we use. And I love this slide, because if you look at it here, you've got two blue charts. And the top blue chart is U.S. money market funds. And what you see is that all of 2023, that blue line has been going up, right? Now, the lower chart is deposits at the big commercial banks. Going back to the latter part of 2021 and all through 2022, those deposits are going down. Now, we did see an uptick in deposits at the big commercial banks at the beginning of 2023. I'm looking at that lower blue chart there. And the reason for that is the banking crisis with Silicon Valley Bank and First Republic and some of the other banks that went out of business. The big banks picked up those assets. But again, if your cash management, whether you are an individual, a small business owner, or running a nonprofit, if it's in these big commercial banks, you're losing money once you factor in inflation. So what a lot of smart people are doing is they're moving over into money markets and insured instruments like that. Again, that's something we can help you out with through our wealth management company, Wealth Builders Investments. But you can go do this on your own as well. I just want to educate you on what's happening in the markets. So banks are out and money markets are in. All right, so I hope that was helpful. What I want to cover now is this first segment is really talking about interest rates, particularly returns on deposits at banks. Takeaway number one really for you is, just in summary, is I want to encourage you to look at your overall financial plan, whether it's personally or professionally for your business or ministry or nonprofit, and look at how you're managing your cash. Because at a very minimum, you can make some very smart, conservative decisions and start investing in some of these risk-free assets and earn a lot more than what the big banks are going to pay you. So that's really takeaway number one. Let me transition now to what's going to be takeaway number two. I want to talk a little bit about the stock market in general. We get a lot of questions at Wealth Builders Investments about what's going on with the stock market. How do we view it? Again, year to date, 2023, again, we're recording this in October of 2023, the NASDAQ, which is primarily technology companies, is up 27%. And that's going to have names like Microsoft, Google, Facebook, all those, NVIDIA, all those tech companies in there. And then you'll see the S&P 500 is up 12% year to date. Now, what's interesting in this chart is technology, NASDAQ, was down significantly last year in 2022. So if you owned technology stocks last year, you probably were contacting us or your financial advisor and saying, why am I down so much in my technology stocks? They were down significantly. I don't have the number in front of me, but it was, they were down. Some of them were down 30, 40, 50% last year in 2022. Now, what goes up comes down, and so that is cyclical. So we've seen technology stocks go back up a pretty good amount, not as much compared to what they were down last year. Now, one thing that I pointed out on some previous shows is this index right here on my chart where you don't see an orange bar graph. And that's what's called the Russell 2000. Now, the Russell 2000 or the Russell 3000, they are a much broader index of companies, right? As the number implies, it's much bigger than 500 in the S&P. But the Russell 2000 is a good barometer of the economy. And here's why. Because the majority of the U.S. economy is based on small business and consumer spending. And the Russell 2000 is an index it includes a lot of those small companies. Well, the small company index is, for the most part, flat, has about a 0% rate of return year to date. And depending on when you look at it, it might be plus or minus that. But again, it has not had near the returns of what the technology stocks have had. Now, what I've shared with our clients is we think this is a harbinger for what's going on in the economy more so than what technology is doing. We think a lot of small businesses are having to tighten the belt. They are having lower sales in certain industries, and consumer spending is starting to tighten up. In fact, we've even seen credit card debt starting to go up more on that. Well, let me share with you this chart. I just found this from some friends at a management company we work with. Now, the S&P 500, if you are invested in that through your 401k or your brokerage account, you may think that you're really diversified. However, it's really the Magnificent Seven, if you remember the old movie, but there's really 7 companies in the S&P 500 that make up almost all the gains. And so I showed you before on this chart that the S&P 500 was up about 12% year to date, again, as of October 2023. But 7 companies of the 500, 7 of those companies are up 50%. And the other 493 companies in the S&P 500 are basically flat. And you'll see that on this chart here. This green line represents really the S&P 7, as we've started to call it. That's going to be the likes of Google, Facebook, Amazon, NVIDIA, Apple, right? I mean, those core companies that everybody knows, they're the ones that are up, but all the other companies really are not up that far. Now, what that means is that if you're up in the market, the market can potentially come down significantly because it's only these 7 companies that are driving the market. So when things turn and we see Facebook, Google, Amazon, Apple, NVIDIA, we see those turn and go down significantly, it's going to bring the entire market down with it. So again, you're more volatile than you think if you're in the S&P 500, and you're certainly not applying any what we call biblically responsible screens or kingdom impact screens if you're in that, which we think helps you with your returns and also helps you not compromise your values for that. Well, let me transition. This is the last slide I have on point number 2, which is what's going on with the market, specifically the stock market. And what we've seen so far year to date in the S&P 500 is certain sectors of the economy are up and certain ones are down. Now, if you'll see here on the right-hand side, there's really 3 main sectors of the economy that are up quite a bit this year. Consumer discretionary, which think Amazon, technology, right? So you think Google's and Facebook, and communication, which obviously is going to include a lot of those like, Apple and Google and all those. Those are technology and communications. Those 3 sectors are up significantly. But look at the rest of the sectors of the U.S. economy. Financials are down, healthcare's down, real estate's down, consumer staples and utilities are all down. Energy's up a little bit. Energy's up about 5% year to date. We actually like energy a lot. We think oil and gas production and consumption is not going anywhere. I'll talk about that here in a minute, but it's important just to take a snapshot of where the stock market is. Almost all the gains this year in 2023 up through October have been through just a small basket of technology and communication companies like we've talked about in the Magnificent Seven. So we actually like looking at some of these other industries, particularly some that pay dividends. We do what's called a pro values dividend portfolio. And a lot of those companies are going to be in some of these other industries, whether it's energy or financials or utilities or consumer staples. We like that. If we think the market's going to have a big correction, which we do, not being so heavily invested in technology and growth stocks and small cap stocks, that's going to help you protect your capital when the market has a correction. All right, so just to wrap up point number 2 before I jump into point number 3, and then I'm going to share with you the handouts, and then I'll finish up the webinar episode by just sharing with you how you can get in touch with us if you'd like to schedule just a personal consultation. Again, with the markets, takeaway number 2 is we do think the stock market is overvalued at where it is today, particularly given that almost all the gains have come from just a small group of technology companies. So again, our opinion for educational purposes is we think people need to be very cautious with their allocation. Another way of saying how much money they have in the stock market, in the broad market right now. We think going into 2024, an election year, I'm going to talk about interest rates for takeaway number 3. We think there is the potential for a great amount of volatility in the stock market and in these technology names that have been up and really been holding the market up while everything else has not really done much to speak of. So that's takeaway number 2. All right, let's continue with kind of our market update and economic outlook. I want to finish on point number 3 with talking about the Federal Reserve Bank. We've talked a lot about this on the Kingdom Finance Show. Chairman Jerome Powell leads the central bank system in the U.S., and they determine monetary policy. So whether you're a student, a stay-at-home mom, or a retiree, or a CEO of a large company, you need to understand how policy works with money. And so again, on this chart, you'll see we've been updating this every month on these webinars, what the Federal Reserve has been doing as far as raising interest rates. So unless you've been living under a rock or on a deserted island, you know that interest rates have been going up around the world. We're talking specifically today about what's happening in the U.S., going back to spring of 2022. Now, in September, the Federal Reserve did not raise interest rates. They said they were going to hold interest rates. But what has happened since September 20th of 2023 is the Federal Reserve said we're not gonna raise rates, but we plan to keep rates higher for longer. And we call that, in our financial industry, we call that a hawkish pause. What it means is it means to you and I as consumers, and I'm going to show you a few charts here. Again, this is for point number 3 on our economic review, is that interest rates are going to stay higher. And what that means is mortgage rates are going to stay higher for longer. And savings rates, what we talked about at the beginning with money markets, CDs, short-term treasuries, those are going to stay higher for longer. What's happened over the last month since the Fed announced this is that rates have gone up. Even though the Fed did not raise rates, bond yields have gone up and mortgage yields have gone up. Let me talk about that here on these next couple of slides. Here's a chart of the U.S. 10-year Treasury note. And if you can't see the chart, don't worry. But for those of you watching, you can see that it's been significantly going up. So rates have spiked quite a lot since the Fed last spoke. And that's why it's good if you're a fixed income investor and you just want to put your money on the sideline and kind of wait for things to shake out with the economy and the upcoming election. It's bad if you're looking to, say, be a first-time home buyer, or you're wanting to move up to a bigger home or move to a different market. Mortgage rates have gone up as well. In fact, the 10-year U.S. Treasury note this week was, I believe, around 4.93%, so almost 5% for that. And let me show you here. The 10-year note, when we did our last economic webinar in September, this 10-year Treasury, U.S. Treasury bond was 4.45%. So what that means is you could go invest in that bond, and that would be the rate you would earn. It's also the rate that is used as a reference or a harbinger for the setting of mortgage rates. Mortgage rates do move independently, but it is a good proxy for what rates are doing. Now, a month later, when we're recording this in October, this 10-year bond has gone up almost 0.5 of a percentage point. Now, that is significant, folks. It's gone up about 10% in a month. It's gone from 4.45 to 4.93 as of October 19th, 2023. In fact, markets are now no longer pricing in any rate cuts this year. They're not even pricing in rate cuts until potentially July of 2024. So to give you some perspective, if you haven't been listening to us, about 3 months ago, 4 months ago, the bond market was expecting rates to be cut by the end of this year, 2023. And in fact, if you talk to your real estate agents or your mortgage brokers or your bankers for lending, they probably said something similar at the beginning of this year. They probably said, well, we think it looks like rates will probably be cut by the end of 2023. So just kind of hang on, and rates are going to be better for buying personal real estate, investment real estate. But what's happened is a complete shift in the narrative from, say, March of 2023 to September and October. So we're not even expecting any interest rate cuts until the summer of next year. And of course, next year, presidential election year in November, there's going to be a lot of volatility, in our personal opinion, with interest rates and the presidential election and what's going on there in 2020. In fact, there's still a chance that at the December Federal Reserve meeting this year of 2023, that we could see another rate hike. Don't know if that's going to happen or not, but it's more likely that they raise interest rates one more time than that they lower them on that. So again, we want to be wise and shrewd when we think about what's happening in the markets, and not just assume that everything's going to be okay. There's some real decisions you can be making as business owners, as entrepreneurs, as personal investors with what's going on. I want you to understand that as really takeaway number 3 for today's show. Let me talk a little bit about mortgage rates. We get that question a lot. We have a lot of families and individuals who invest in real estate, and just like everyone who have personal homes. The 30-year mortgage rate last month on this same show was around 7.5 to 7.6% in September of 2023. Now, today, at the recording of our October episode, the average 30-year mortgage, now again, it varies from region to region, but the average 30-year mortgage is now hovering around 8%. And in fact, in some markets, we're seeing it tick higher than 8%. That's the highest it's been since December of 2000, Y2K, right? So we think this trend continues. We do not see mortgage rates going down between now and the first of the year. We do think, our opinion, we do think equilibrium for mortgage rates is probably around 5 to 5.5%. Again, I think it may take 18 to 24 months before we see mortgage rates back to that level, based on what the bond market is telling us and what the Federal Reserve is saying from that. Now, I know that's not great news for some of you, but again, we just have to ride these cycles out on that. Mortgage rates could actually creep higher. I do think if mortgage rates continue to creep higher into 2024 and the spring's selling season, when we see geographically, we see more houses on the market in the spring. If we see 8.5%, 9% mortgage rates in the spring, I think that will have a significant impact on the price of real estate. And we're talking about single family residential real estate primarily here. But I think that will have a really big impact on that. So if you're an investor or just a personal home buyer, I think we have the potential to see some opportunities for prices in the spring to come down if mortgage rates, I'm talking about, continue to go up. All right. Well, let's move on. One other comment on mortgage rates and real estate, because we get a lot of this in our Wealth Builders community, is I want to show you this chart, and then I'll kind of wrap up the show today, and I'll provide you the handout, and we'll talk about how you can get your personal consultation if you are interested. This chart here shows the nominal effective rate for mortgage rates. And let me just explain what this chart is. It comes from BCA research, but The black line is 30-year mortgage rates, what I've been teaching on. And what you see is in 2020, you see rates, that black line was very low. So mortgage rates were very low at the peak of COVID, right? Federal Reserve was at 0%. Mortgage rates were, 2.5%. Now, since then, they have gone straight up. And as I've already referenced, mortgage rates are fast approaching 8%. Now, a lot of people, and many of you on the program today, many of you watching this episode, even on replay, you own a personal residence, and your effective rate on your mortgage is much lower than what current mortgage rates are. And you see that represented by the green line on my chart here. Many of you have more personal mortgages on your personal residence and even on investment property that are more like 3%, 3.5%, 4%, right? Even 4.5% is not bad compared to where rates are. So what a lot of people are doing is they're just staying in their current home, right? Because their current home, it's gone up in value, and they had the mortgage on it is at 3%. And so why would they go sell their home to go buy a new home and have a 7 or 8% mortgage, right? I mean, the math just doesn't add up. So a lot of people are just staying in their current home. Now, everyone needs housing. And so that there's still always going to be volume in the single family real estate market, because people retire, people take new jobs. You always have life transition, so there's always going to be inventory. But that's one of the reasons why the inventory has been so low, is with rates being so high, there's not going to be as many houses coming on the market, because, and many of you are probably shaking your head listening to me saying, well, yeah, I don't want to sell and get out of my 3% mortgage and go get an 8% mortgage, right? That payment's going to be significantly higher. Even if you're making good 6-figure income, that's still going to be a much higher mortgage payment than what you've been used to. All right, well, let me land the plane here on today's show. I really appreciate you being here. Again, we've really covered 3 main takeaways on that, but I want to also give you some insight into how we are investing in our portfolios. And for those of you that are clients, you've probably heard us talk about this when we've done phone calls and reviews. Just to circle back to what I shared at the beginning, we do like fixed income right now, short-term fixed income. I mentioned to you about CDs and treasury bonds and money markets. There's nothing wrong with just putting money in short-term fixed income right now and getting 4.5%, 5% on that. There's absolutely nothing wrong with that. We're actually doing a lot of that ourselves right now. And we do that in 2 different ways. We do it in just with some of the fixed income that I mentioned at the top of my presentation. And we also do it in what's called private credit. So there's 2 different types of fixed income that we invest in. Again, happy to share more with you one-on-one about specifically, but even if you're not working with our team or a financial advisor, you can go out and invest locally. We encourage you not to invest with the big 5 commercial banks. 1, they don't share our values, and 2, they're not going to pay you much. But if you work with a local or regional bank or credit union, likewise, if you do want to engage us at Wealth Builders Investments, we can help you on that. So point number 1 on our portfolios, we like just short-term fixed income. We like that. We're not going to be greedy about where the markets are. We think there's going to be a lot more opportunity going into 2024 on that. So fixed income, we like it. There's 2 or 3 different types of it. We like short-term fixed income. We like the idea of getting 4 or 5% on our money and having it liquid for opportunities that will come up. When it comes to the second asset class, I call this the wait and watch. We're waiting and watching when it comes to stock market equities and real estate. As you probably already figured out from my comments today, we do like high quality dividend focused companies when it comes to the stock market. We also like companies that we have done a pro values screen on to ensure they're not violating our personal ethics and values. We also think that by doing a pro values screen, we're going to find companies that have higher employee retention. They have better market share in their communities just because they're running their business with Christian ethics. Real estate, again, we do expect some meaningful geographic opportunities as we go into 2024. You really want to focus on areas where job creation, strong local economies. They're probably going to be more red states, where you see companies relocating jobs, low taxes. Those are going to continue to provide some opportunities. I was actually talking to some folks in Alabama today that have followed us, and I just encourage them, hey, I think Alabama's got some great markets, as does Tennessee and that whole southeast corridor. There's nothing wrong with starting to do some research on investing in real estate in some of those markets. Now, you don't have to live there; you can live out of state, but a lot of good markets: Colorado, Arizona, Texas, a lot of states that you can invest in single family, multifamily. But we're taking a wait and watch. You kind of want to get your shopping list together, both for equities and for real estate as we head into 2024. And while you're doing that, you're just going to put your money in some of these risk-free assets and earn 5%. Nothing wrong with that at all. The third point on our just update on our investment portfolio, we are big proponents of having investments in non-correlated assets. And we do have some other teachings on this, but three of the things we like are oil and gas, wildlife conservation, and private equity. Now, I don't have time for today's show to go into each one of those, but if you're interested, please connect with us for a one-on-one. And we have some other episodes on the Kingdom Finance Show where we talk about that. But again, we're looking for non-correlated, just means they act differently than traditional stock and bond investments. It's going to help you potentially diversify more and protect your assets over the long term for that. So three of the ones that we personally invest in include private equity, wildlife conservation, and then oil and gas on that. So that's an update on our portfolios, just to give you a little inside look on what we're thinking at the investment committee level. Hey, I appreciate you all being here. Again, please check out the Kingdom Finance Show. A couple things just to wrap up, and thank you for staying around for all the show. I'm going to share the handout here. So again, if you're on this webinar live, you can go ahead and click the Get My PowerPoint Slides in the handout section. And if you're watching this in the recorded format, just reach out to us at info@wealthbuilders.net, and we'll send you the handouts from today's show. And we'll also put these in the show notes when we post this on the Kingdom Finance Show. So again, please click that. And then let me also show you a couple other things. If you would like, you'll see, again, if you're with me live, just as we kind of wrap up here, you've got two different tabs on your screen. You've got an offer and a handout. So click on the handout, and then you can click the green Get My PowerPoint Slides. That'll give you a PDF of today's presentation. If you're watching this after the live, just look in the show notes for the handouts there. And then finally, we do want to make our team at Wealth Builders Investments available to you. And so what I want to encourage you is, if you like the idea of, hey, been following you, Chad, we like your values approach, we like your philosophy, we'd like to learn more. I know many of you may be first-time visitors to us. You may have come in through Lance Wallnow or Billy Epperhart or just through the Kingdom Finance Show, but we want to connect with you. And so anything we can do to educate and empower you to be a good steward with your business, with your investments, we would love to do that. So there's a link here in the webinar for a 15-minute phone consult. And again, if you're watching this in a recording, there's a link in the show notes for that. So please click on that green icon where it says 15-minute phone consult. And then we'd love to connect with you, hear your story. We're not here to sell you anything. We want to be a resource for you to provide you personal education. If you do want personal advice, the best way for us to do that is just in a one-on-one environment. Some of you may just want a second opinion on what you're doing. We talk to a lot of people all over the country who say, hey, Chad, following you, we like your philosophy and what you guys are doing. But we're already working with a financial advisor, and that's great. We want to encourage you to continue working with your advisor if it's a good fit. But if you feel like, hey, Chad, I would like a second opinion. I would like to understand how kingdom impact investing or conservative values investing fits into my overall portfolio. I'd like to understand how to diversify more into other things besides stocks and bonds. Or you might say, hey, I'd like to learn more about how to save money on taxes and how to do proper estate planning for my family and my business and my ministry. Those are some of the things we offer at Wealth Builders Investments. So again, just depending on what your needs are, those are going to be the areas where we'd love to help you. So please click on the link for a complimentary, again, no obligation, phone consultation with our team. And we've got a whole team here at Wealth Builders Investments. We would love to visit with you on that. So with that, I'm going to conclude today's webinar episode. Really appreciate you being a part of it. Again, please follow us at the Kingdom Finance Show. Please subscribe and like it. You can also, follow me on Twitter at Chad Franzen. You can follow us on that. That's the best way to kind of know what we're talking about, what we're thinking. We do these types of webinars every month. So if you like it, please continue to sign up for next month's webinar. We'll be back in November to do more of our year-end, year-end summary for the markets and the economy. And 2024 is going to be very interesting. So I want you to be equipped and prepared for what's coming, and also make good decisions with your financial resources. Hey, thanks so much. Again, I'm Chad Franzen. On behalf of Wealth Builders Investments, our team, and the Kingdom Finance Show, thank you for being here. Again, please click on the phone consult. If you're a current client and you just want to check in with us, that's a great way just to schedule some time with me or the team. And if you're new to us and you just want to learn more about how we work, that's a great way to connect as well. So with that, I'm going to sign off. Please download the handouts and then sign up for a phone call if that's of interest to you. We wish you the best. Stay safe and healthy. God bless. And thanks for being a part of today's Wealth Builders Investments Economic Outlook for October 2023. We'll see you next time. Take care.